Apartment investors have been waiting for the market to turn. But what if we're watching that happen right now and you've just been looking at the wrong signals? In some of our local markets, values are starting to stabilize. In others, they're still falling. And rents? Some have dropped nearly 12% since the beginning of 2025. I just finished analyzing the first 6 months of 2026, and if you own apartments in Southern California, what this data is telling us may change what you do next. If you own apartments in Southern California, there's something happening in the market right now that you need to see. Because after several years of declining values, investors have been waiting for the market to move. Are values finally beginning to stabilize, or do we have another leg down coming? Well, I just finished analyzing the first 6 months of 2026, and the answer depends a lot on where you own. In some markets, prices are still falling. In others, they've barely moved. Cap rates are expanding in some areas, compressing in others. And maybe most surprisingly, rents aren't behaving the same either in all the different areas. In some of our markets, they're holding up remarkably well. In others, studios and one bedrooms have fallen close to 10% or more since the beginning of 2025. So if you're sitting on an apartment building thinking, I'll wait for rates to come down, rents will just keep going up, and eventually my value will come back, you need to see these numbers. Because the market is telling us something different depending on where you own. And by the end of this video, I'm going to show you exactly what's happening in your part of the market, what buyers are paying, where cap rates and GRM are moving, what's happening with rents, and what I think it means for the second half of 2026. Now, if you own apartments here in Southern California or are looking to get in the market, hit the like button and subscribe. We track this data specifically for the markets we serve, and I'll continue to keep you updated as these numbers change. All right, now let's start with the big picture. Here's what makes this market so difficult to read. If you've been waiting for the economy to fall apart and force interest rates dramatically lower, that hasn't happened. The latest GDP report showed the economy grew at only a 1.5% annualized rate during the second quarter, but underneath that headline, the numbers were considerably stronger. Consumer spending grew by 3.2%. Private domestic demand grew by 3.9%. And private fixed investment grew by 6.7%, with a lot of money continuing to pour into AI, computing, and technology. So the economy is still moving. But then look at employment. The July jobs report, to a lot of people's surprise, showed the economy actually lost 23,000 jobs. And May and June were revised downward by another 103,000 jobs combined. Wage growth slowed. Labor force participation fell. So we're starting to see some real weakness in employment. And so you would think, okay, that's going to push interest rates down. Not necessarily, because inflation is still a problem. And there's something else happening that apartment owners need to understand. The Fed has held its benchmark rate at 3.5 to 3.75% now for the last few meetings. But long-term Treasury yields have moved higher. The 30-year Treasury recently hit approximately 5.2%, its highest level since 2007. That's a big deal. Because when you're financing an apartment building, the Fed funds rate isn't the only rate that matters. Long-term commercial real estate financing is heavily influenced by Treasury yields. So here's the mistake I don't want investors making. Don't build your entire strategy around what the Fed may do next or the Fed rescuing you. If the Fed eventually lowers short-term rates, that doesn't guarantee your apartment loan suddenly gets cheaper. And when the cost of capital stays elevated, buyers have to adjust. They can either put more money down and accept a lower return, or they lower the price they're willing to pay. And guess which one we're seeing right now? Now, let's look at the actual sales. Let's dive into the market data. Again, the information that I'm going to speak to are the markets that my team and I service, where we represent landlords in the purchase and sale of multifamily properties. So this does cover a good portion of LA County and San Bernardino County, but obviously not the entire southern hemisphere of the state of California, right? So we select markets and we have the data to these specific markets because these are the markets that I work in and day out. So we break the information down by corridors. The corridors are segmented because values are typically the same, rental rates are typically the same, and the tenant demographic is typically the same amongst these corridors. So first we have the East San Gabriel Valley corridor. That consists of Azusa, Baltimore Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. We have the Western San Gabriel Valley, which consists of Rosemead, San Gabriel, and Temple City. We have Pasadena, which is Pasadena, South Pasadena, Sierra Madre, that general area. We have the East LA corridor, Boyle Heights, East LA, 90022, 90023, El Sereno. The 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. We have the 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier. The Inland Empire West, which is Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. And then the Inland Empire East, Bloomington, Colton, Fontana, Rialto. So as I walk through the data in this market update video, we're going to chunk it down by corridor. Again, my opening comments were to the broader picture of what's going on in the multifamily market. Now we're going to get much more granular in terms of the specific price per unit, cap rate, GRM to these local markets. So let's start in the East San Gabriel Valley corridor. And here I would say we're seeing continuing softness, but nothing that looks like the bottom is falling out. We had 25 sales through June of this year. So again, January to June 2026. At that pace, we'd finish the year at roughly 50 transactions, compared with 59 last year. So transaction volume thus far is down about 15% year to date. Average price per unit moved approximately from $272,000 last year to $263,000 on average for the sales that occurred so far this year. That's another 3.3% decline over the declines we've seen the last couple of years. Cap rates, basically unchanged. Last year we were sitting at 5.29%. This year we're at 5.24%. GRM is almost identical as well. 13.26 last year versus 13.22 currently. So we're not seeing a dramatic change in the income multiple, but buyers are paying a little less per unit. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So you find your city of choice, you go and find your bedroom count across, and that's the average. My team digs into Zillow, Rentometer, and CoStar. We'd look up all the average rental rates, and that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. Now, let's look at the rents. Studios in this market are down by 3% year over year. One bedrooms are down 1.5%. Three bedrooms are down just over 2%. But two bedrooms have taken the biggest hit, down almost 6%. So the Eastern San Gabriel Valley isn't giving me a strong signal that values have turned around just yet. Prices are still drifting lower, rents have softened, and fewer deals are trading. Nothing catastrophic, but I wouldn't call it a recovery just yet. Now let's move over to the Western San Gabriel Valley because the story changes here. We've had 11 sales so far this year. And at that pace, transaction activity would finish approximately 29% ahead of last year. So deals are happening, but buyers are getting a better price. The average price per unit moved approximately from $335,000 last year on average to now $320,000. That's down 4.5%. Cap rates have moved from 4.49% to 4.66%. That's about an 18 basis point increase. GRM actually moved higher from 14.68 to 15.3. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So you find your city of choice, you go and find your bedroom count across, and rents, it's mixed. Studios are down about 4%. One bedrooms are actually up about 1%. Two bedrooms are down roughly 4%. Three bedrooms are down about 2%. So I wouldn't describe this as a rental market that's falling apart. It's softer. But here's what's catching my attention. More deals are getting done. That tells me buyers and sellers are getting closer on price, right? There's more of a meeting of the minds, as they say. Owners may not love the new price, but the market is beginning to transact, and that's the big bonus there. Pasadena. This might be the most interesting market in the area, the different areas we track, because buyers haven't disappeared. We had 23 sales through June. At that pace, transaction activity is running approximately 10% ahead of last year. But here's what buyers aren't doing. They're not paying last year's prices. Average price per unit has declined from $329,000 on average to $303,000. That's almost an 8% decline. And cap rates jumped from 4.98 to 5.65. That's approximately a 67 basis point move. GRM moved from 13.9 to 12.72. So there are buyers. They're writing checks. Deals are closing. They're simply demanding a better return. Now, here again, a component of this is Pasadena, not South Pasadena, but Pasadena has localized rent control. And the rules are pretty tough there. So if you're an investor, essentially you're saying, hey, I need a greater return day one. That brings the value down, the cap rate up, because I can only raise the rents marginally year after year from that point after I close escrow. So I need to start at a higher rate of return. And again, that can be said for any of these cities that have localized rent control. The general idea is you need to buy at a higher return, higher cap rate, because from that point going forward, your rental increases are limited. And if nobody moves out of the building, then your destiny is essentially etched in stone, because you know you're only going to be able to raise those rents incrementally. That means your cash flow only grows at a certain rate and the building only appreciates at a certain rate, versus the surrounding cities, let's say, that have no localized rent control and they're able to raise their rents, say 3 times what you could raise your rents. These are all factors going into it. So I'm not saying don't invest in a city that has localized rent control. I own in areas that have localized rent control, but the returns have to make sense. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So you find your city of choice, you go and find your bedroom count across, and that's the average. My team digs into Zillow, Rentometer, and CoStar. We'd look up all the average rental rates, and that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. Now let's look at the rental numbers here in Pasadena. These are pretty interesting. Studios are down less than 2%. 1 bedrooms are down about 4%, but 2 bedroom rents are actually up almost 2%, and 3 bedrooms are basically flat. So you can't, again, explain an 8% decline in value or price per unit simply by saying, well, rents collapsed, because they didn't, right? So again, especially on the larger units. So that gets back to the localized rent control component. Now let's go to the 605 corridor. We've had so far this year 35 sales. That puts us on pace for approximately 70 this year versus 79 last year. So that would be about down by 11%. The average price per unit dropped approximately from $259,000 last year to $248,000. That's about a 4% decline. Cap rates have moved slightly higher, 5.24% to 5.36%. And GRM moved down from 12.9 to 12.5. That's about a 3% compression. This is pretty straightforward. Buyers are paying less and getting a slightly better return. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So you find your city of choice, you go and find your bedroom count across, and that's the average. My team digs into Zillow, Rentometer, and CoStar. We'd look up all the average rental rates, and that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. But rents are holding up considerably better than values. Studios are down about 2.5%. 1 bedrooms are down just over 1%. 2 bedrooms are down less than 2%. And 3 bedrooms are actually slightly higher than they were at the beginning of 2025. So if you own along the 605 corridor, this is an important distinction. Values have softened more than rents. That tells me financing and the returns buyers are demanding are still playing a meaningful role in a property's valuation. Now, if we move over to the 710-91 corridor, and here I pay particular attention to the rental numbers. We had 23 sales through June, putting transaction activity slightly ahead of last year's pace. But average price per unit declined from approximately $208,000 to $196,000. That's almost a 6% decline. Cap rates actually moved slightly lower from 5.98% to 5.84%. And GRM barely moved at all, roughly around 11.3. So the sales data alone doesn't tell us that buyers suddenly demanded a dramatically higher return. But then you have to look at the rents. My team digs into Zillow, Rentometer, and CoStar. We'd look up all the average rental rates, and that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. Studios are down almost 9%. One bedrooms are down almost 5%. Two bedrooms are down close to 4%. And three bedrooms are down close to 4%. That's broad-based rental softness, and that's important because here, part of the pressure on value may be coming from the income side of the equation. The property is essentially collecting less income. That has a direct impact on the value. If your market rent comes down, the upside a buyer is underwriting comes down with it. And when the upside gets smaller, the price they're willing to pay gets smaller as well. And especially here in the 1091 corridor, because a number of the cities have localized rent control, that also is what's played a role in decimating the values, say, over the last 3 to 5 years. So that's another key, distinction we have to look at is when you're looking at a specific rental market, a specific city, do they have localized rent control? In general, the trade-off is deals are priced better, but you cannot raise your rents to the limits that's allowable under statewide rent control. So you best to know what the limits are. And if you don't know if your city has localized rent control, I suggest you look into that. I just spoke to an investor just yesterday who didn't realize the city he owns in has specialized rent control above and beyond statewide rent control. And which tells me he probably has raised rents above the legal limits, which creates a whole basket of problems. So again, owners, you should know what are the local rules for your city, and would-be buyers as you're looking at different cities. Again, not too many cities have localized rent control. All cities in California are under statewide rent control. Very few cities have localized rent control, but that's an important detail to know as you look at different properties to purchase. Now, the East Los Angeles corridor doesn't really surprise me, and this is because of localized rent control. You take a look at everything, and and especially 90022, they're under the unincorporated LA County rules, horrible rules, and so there's a lot this market has gone through. But the numbers are pretty stable. So far this year, there's been 9 sales. And so that puts transaction volume about 14% behind where we were last year. But average price per unit, it's approximately $177,500 last year. This year, it's about $177,000, so basically flat. And cap rates moved from 5.96 to 5.43%. GRM moved from 11.78 to about 12.11 on average. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So you find your city of choice, you go and find your bedroom count across, and that's the average. My team digs into Zillow, Rentometer, and CoStar. We'd look up all the average rental rates, and that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. The rental market has held up. Studios are actually up approximately 4.5%, although some of that increase is being driven by stronger studio rents like cities in Boyle Heights or sub areas like Boyle Heights. One bedrooms are basically flat, two bedrooms are basically flat, three bedrooms are basically flat. So I'm not going to tell you East LA is suddenly booming. It's not. Volume is still relatively low. But after the repricing we've already experienced there, we may finally be seeing some stabilization. And that's something I'm going to be watching very closely through the rest of this year. It's priced affordable, right, from a buyer's perspective, price per unit, cap rate, but you are tangling with localized rent control, unincorporated LA County. So something to be aware of. Okay, now let's head to the Inland Empire. Let's start in the West Inland Empire. This is probably the rental story that concerns me the most. Only 7 properties have traded through June. At that pace, transaction velocity would be down about 30% compared to 2025. Interestingly, average price per unit hasn't really moved. approximately 232,000 last year, and this year is approximately 233,000. So we're basically flat. Cap rates have moved from 5.58% to 5.17%. And GRM moved from 12.25 to 11.44. But remember, we're only dealing with 7 transactions. So again, that can skew the financials. And that's what this chart is. It's a combination of the average rental rates on market right now at the current asking values. So I'm careful about reading too much into those averages. The rental data is harder to dismiss though. Studio rents are down about 12%. 1-bedrooms are down almost 9%. But 2 and 3 bedroom units are down only about 2.5% to 3%. That's a big difference. And if you're an investor in this market, unit mix matters. If you own a building filled with studios and 1-bedrooms, you're looking at a very different rental environment than somebody who owns mostly 2 and 3 bedroom units. That's exactly why broad market averages can get investors into trouble. So another component of this too would be, remember, starting with COVID, there was a max exodus from people from the cities to the suburbs. The Inland Empire rental rates took off like a hockey stick. Now they've retreated backwards, and I believe you see the larger units doing better because people are doubling up, families living with family. It's a force of the current economics. So these are, again, things to be cognizant of as you look at the Inland Empire. Great place to invest. I'm invested there personally as well as some of the other markets I've discussed. But again, you just got to follow the metrics closely. Now, in the East Inland Empire, there really hasn't been enough sales data for us to project one way or the other. And annually, there's just not a lot of properties that sell in this particular corridor because there's not a lot of stock. Again, we're tracking buildings that are between 5 to 50 units, so there's not a lot of stock in this particular corridor that trades hands. So far this year, we've only had 3 sales through June. Price per unit is showing a decline of almost 4%. And cap rates jumped from 5.43% to 7%. GRM dropped from 12.47 to about 10. Now, that's an enormous movement in the market. But remember, only 3 transactions have taken place this year. There's not much supply. And even in a good year, there's not a lot of properties that trade hands. So I'm not going to sit here and tell an owner that, hey, your building's lost 25% of its value. That would be irresponsible. What I would pay more attention to right now are the rental rates. Now, before we dig into the changes in the rental rates since 2025 to current, here's your current rental rates. So studios are down about 6%. 1-bedrooms are down less than 2%. 2 bedrooms are down about 3.5%, and 3 bedrooms are down roughly 2.5%. So yes, rents have softened. But nothing in the rental data suggests anything close to the dramatic movement we're seeing on the sales side. So again, take caution here. Not enough data, I think, to give this corridor a fair shake. We really need more transactions before we can trust what the signals are of the market. Now, let's go back to the question I asked at the beginning. Are apartment values finally stabilizing? Or is there another leg down coming? After going through all of this data, I don't think you can give one answer for Southern California. And that's probably the biggest takeaway from our video today. We're no longer dealing with one market. East LA, for example, is showing signs of stabilization. The 605 corridor is seeing some additional price pressure, but rents are holding relatively well. Pasadena is still repricing, even though larger unit rents remain strong. The 710-91 corridor has pressure on both values and rents. And in the Inland Empire, you have a meaningful hit when it comes to values and rental rates. So we have different markets, different unit mixes, different outcomes. But there is one broader trend that I see. Buyers haven't gone away. They're disciplined. They're looking at the debt. They're looking at actual rents. They're looking at expenses. They're looking at the return they're getting on their money. And then they're deciding what they're willing to pay. That's the market. And I think we're gradually moving from a period where buyers and sellers couldn't agree on value to a market where, again, we have more of a meeting of the minds, just at a different price than many sellers would hope for. That's why I would describe this market as still being in price discovery. Not a crash. I don't think the data supports calling it a recovery year yet either. The There's one takeaway I don't want apartment owners to miss. For years, one of the easiest assumptions to make was, even if values get hit temporarily, I'll hold the property. Rents will keep going up. My NOI will grow. Eventually, value catches back up. Maybe. But look at the data we just went through. In a number of our markets, rents didn't go up. They went down. And one of the clearest patterns we're seeing is that smaller units have generally experienced more pressure. That matters. Because if you're underwriting your own property, assuming, say, a 4 or 5%, 6% annual rent growth, and your market is actually flat, or even worse, it's down 5%, unbeknownst to you, that's a very different investment. And here's where I think investors need to be careful. Don't confuse waiting with having a strategy. Sometimes holding is absolutely the right move. I tell clients to hold all the time. But holding should be a decision based on numbers, financials, not emotion. Not because you're waiting for 2021 pricing to magically come back. So what should you actually do with this information? I would pressure test your investment. 3 things: your value, your income, your debt. What is the property really worth based on transactions happening right now? Not 3 years ago. Not what your neighbor thinks your building's worth. What will somebody actually write a check for? Second, look at your rents. What's your loss to lease? What are your units compared to the actual market rents we're seeing now? And don't automatically assume the answer is that your rents are too low. In some areas, owners may discover the market itself moved towards them even though they had more conservative rents. And then third, look at your debt. When does it mature? What's your current rate? What happens to your cash flow if you refinance at today's terms? Are you at 3.5%? Today you'd have to refi, say, at over 6%. Because if you're waiting for rates to fall before you make a decision, you need to understand what happens if they don't, or if they fall much slower than you're expecting. Then you can make a decision. Hold, improve the property, refinance, sell, 1031 exchange. It's different for everybody. It's dependent upon your portfolio. It's different upon your goals. It's different based upon your current rate of return. But you have to make the decision with the current information. And that's actually why we're doing something a little different later this month. On August 27th at noon, I'm hosting a live multifamily investor webinar. Because here's the problem. I can show you what has already happened. That's what we did in the video today. But the decisions you're making now depend on what's happening next. Where are interest rates likely to go? What legal changes should landlords be preparing for? What are lenders seeing? What should you be thinking about from a tax standpoint? If you sell, does a 1031 exchange make sense? If you hold, what should you be doing now? Those aren't questions one person should pretend to have every answer to. So I'm bringing the people who deal with these issues every day into one conversation. Real estate attorneys, lenders, tax and 1031 experts, real estate professionals, market forecasters. And we're going to talk about today's market and tomorrow's challenges. More importantly, we're taking your questions live. So bring us the issue you're dealing with. Bring us the question you've been asking your CPA, your attorney, your lender, your broker. Let's talk about it. This isn't a sales pitch, it's information. And in a market like this, the quality of the information you receive can make all the difference. Registration is free. The link is below here in the description. We may have a QR code here, okay? Get yourself registered. 1 hour of your time invested, and it'll make all the difference on how you carry out not only just the rest of this year, but in the years to come with respect to your multifamily portfolio. These are the professionals that Chris turns to, that me and my wife, when I have a question, I'm in the middle of a sale or a purchase, who I turn to say, hey, here's what I'm thinking. Let me bounce these ideas off of you. Are there things that I should be considering? These various facets of owning right from the legal side, tax side, and so forth. Get yourself registered for our webinar. A number of you say, hey, Chris, it's not fair. We cannot go to your live educational luncheons. I'm bringing the luncheon to you, August 27th. Now, if you want to take this one step further and understand what do these numbers actually mean for your property, for your portfolio that I've discussed today, reach out to me. We'll look at your property. We'll look at your rents. We'll look at your debt. We'll look at the total picture, right? We'll look at what comparable properties you're actually selling for in your area. And if you own multiple properties, we can do the same thing across your entire portfolio. Maybe the answer is sell. Maybe it's exchange. Maybe it's refinance. Maybe the smartest thing you can do is absolutely nothing, but at least you'll know why based upon the numbers. If you got value out of today's update, our video here, hit the like button, subscribe to the channel, and send this video to another apartment owner who should see these numbers. And make sure, again, you register for our live educational webinar on August 27th. I'm Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and a financial legacy you can be proud of. See you on the 27th.